Hi everybody, Dr. Phil here. So this is going to be a video on master budgets and looking at the budgeting process and a little bit about performance planning. So let's go ahead and jump right into it. So firstly, the budgeting process. So this is kind of how a budget is developed at a very topological level. The budget is developed. We're going to compare the actual to the budget kind of as we go through the period. We're going to take action to correct if we need to, and then we're going to set new plans. So we can think of budgeting as the process of planning future business actions and expressing them as formal plans. Okay. Now, obviously, budgeting isn't something that's just done in the corporate world. Obviously, most of us, I certainly do. I'm sure most of you do too. Like to have a budget, like to see where's the money going, how much am I saving, how are things going relative to what I was trying to do for this month, this quarter, this year, or whatever the time period may be. So a budget is formally defined as a formal statement of a company's plans in dollars, right? Makes perfect sense. The budgetary control process, we can think of this as management's use of budgets to see that planned objectives are met, to make sure the money is coming in and going out in essence as we expected, as we anticipated. So what are some of the benefits of budgeting? So we have a plan. The plan focuses on the future opportunities and threats. We have an element of control, provides a benchmark for evaluating performance, obviously. It helps us coordinate the activities of all employees and departments to work toward the company's overall goals. Communication, so we can communicate management specific action plans to all employees. And motivate as far as budgeting performance levels, provide goals for employees to attain or exceed. So this is kind of an overview of the master budget process components. So we always start with a sales budget. Think about why, because until we have an idea as to how much we're going to sell, we don't know how much to produce. If we don't know how much to produce, we don't know how much materials we're going to need, we don't know how much labor we're going to need, and we don't know how much overhead we'll also need. Once we have an idea of these three, the materials, labor, and overhead, we have an idea as to how much cash will be coming in, going out, and then think about some of the uses and sources of cash, capital expenditures. Think of, if that may be a term you've heard before, if maybe you're not familiar with it, capital expenditures, sometimes we just call them CapEx, is sort of like big, expensive assets. Maybe things that maybe we have to, issue bonds, issue debt to pay for. They're not cheap, and they usually last for quite a while. And then we have on the right selling expenses, general and admin expenses. Of course, both of these are also driven by sales. If your sales suddenly increase, perhaps you need more machinery, so you have to think about your your CapEx budget. Also, if your sales increase, then it's likely that your selling and general and admin expenses will also increase. So here's a look at a balance sheet. So we can see this Toronto Sticks Company, right? We've got our assets on the left, we've got our liabilities and equity on the right. Now we can see, of course, the assets, $229,930, equal our total liabilities and equity, as it should. We've got various assets here. We've got some current assets, cash, accounts receivable, inventories. We've got some longer term down here, equipment, minus the accumulated depreciation, with a book value of $164. On the right, we've got our liabilities. We've got some money sitting in accounts payable, so we owe other people about $7,000 for AP. We are income taxes payable to the local government, federal government, etc. We have a loan payable in the amount of $10,000. And then we have, obviously, our equity, the two principal components, common stock. Think about the money that people kicked in to kind of start the business, and any secondary offerings thereafter. And then money that we've built up in the course of operations, retained earnings. So let's start by looking at a sales budget. So we're going to work through each of those budgets. When we were looking at this, I said we start with the sales, we go down to production. So what we'll do is we'll just look kind of briefly at each one, just to kind of get you on your way with these. So it says in September, Toronto Sticks Company sold 700 hockey sticks at $60 each. Toronto Sticks prepared the following sales budget for the next 3 months. So what we have here is basically the fourth quarter of the year, right? October, November, December. They're budgeting to sell 1,000 in October, 800 November, 1,400 in December. Obviously the selling price, which apparently isn't going to change during that period, is 60 bucks. So if this holds, and remember this is a guess, right? This is a budget, this is a sort of, I like to say guesstimate, right? Then they would make 60,000 in October sales, 48,000 sales November, 84,000 sales December, if you add those up, for a total of 192,000. So that's right. Basically, if you think about what you learn in economics, P times Q, right? Price times quantity. Price, 60 bucks a unit times quantity, 1,000, 800, and 1,400 respectively. So that's pretty much all you have to do for the sales budget. So what about computing production requirements? So a manufacturer prepares a production budget which shows the number of units to be produced in a period. So the budget is based on the unit sales projected in the sales budget. So think about what we just saw here, projected sales for each month, along with inventory considerations. And we'll talk a little bit more about that in a second. So the units to produce equals the budgeted ending inventory units. So think about how many do you want to have left over after you've sold all your stuff for the period, plus budgeted unit sales, so what you actually want to sell in the period, minus beginning finished goods inventory. So another way you could say this, these three components is units to produce equals how much I want to have left over, plus what I want to sell, minus, what's already sitting here. Because, if I need like 1,000 units and I've already got 300 sitting here, then I only need to buy 700. So let's take a look at a production budget. So the production budget is based on the unit sales projected in the sales budget, along with inventory considerations. So if you go back and look at the sales budget, you can kind of rewind the video a little bit to go back a couple of minutes and look at that. These were the numbers, right? 1,000 October unit sales, 800 and 1,400 for November and December. So the first thing we do is plug this in. Then we say, well, let's add in the desired ending inventory. Okay, so it says next period's budgeted sales in units, and they want to have, it's 800, right? This is the 800 for November, and then of course the 1,400 from December. And they want to have a ratio of inventory to future sales of 90%. So what they're basically saying is, we know that in October, we're going to sell, or we hope to sell 1,000 units. In November, think about the relationship between these two. This is the same number. We should sell 800. We want to have 90% of that left over at the end of October. So if we take the 800 for November, times it by 90%, 0.9, we have 720 as our desired ending inventory for October. So our total required units is 1,720, okay? Then we say, well, how many units do we basically already have sitting there, i.e. beginning inventory units, 1,010. So once we've taken those out, we only need to produce 710. So as long as we produce 710, we can add those to the 1,010 we've already got. That'll give us the 1,720. We'll have the 720 left over, and then we'll have the 1,000 available to sell. And then we'll just run through November real quick. It's exactly the same logic. So we're going to sell, we should sell 800 in November. The next period's budgeted sales, i.e. December, is 1,400. Look at December. We want to have 90% of that. So 1,400 times 0.9 is your 1,260. If you take the desired ending inventory of 1,260, and then we're going to say we need 2,060, right? So the 800 that we should sell in November, and then the 1,260 we want to have left over at the end of November. So if we add those together, we get the 2,060. And then we say, okay, well, what about the beginning inventory? So the beginning inventory for November, look at these arrows, is the ending inventory for October, right? So think about this, right? It's the last day of October. We come into work. Everybody goes home October 31st. We turn the lights off. There's 720 units sitting in the warehouse, or the production line, whatever. We go home, go to bed, get up in the morning, come back into work. It's now November the 1st. So now it's beginning inventory for November. So think about like last day of October, first day of November. So in this case, we need 1,340. So again, for November, as long as we produce 1,340 units, we'll have what we need left over, and then we'll be able to satisfy the current period's budgeted sales of 800. And the same logic for December. All right, computing materials to be purchased. So the direct materials budget is based on the production budget. So materials to be purchased is units to produce times the materials required per unit, plus desired ending materials inventory, minus beginning materials inventory. So you kind of see that it's actually pretty similar to the last one, right? We're going to add in our desired inventory at the end. We're going to subtract our beginning materials inventory. So let's take a look at that. So the direct materials budget shows the budgeted costs for the direct materials that will need to be purchased to satisfy the estimated production for the period. So units to produce, they're going to produce 710. Materials required per unit, so they need half a pound per unit, so times 0.5. So materials needed for production is 355 pounds. What they're really saying there is if you want to produce 710 units, you need to purchase 355 pounds, right, based on using half a pound per unit. So we add the desired ending materials inventory, which in this case is 335. Now you notice here there's an arrow, and it says times 50%, and it points at the 335. What they're saying here is that we want to have 50% of, look at this, 670, the materials needed for November production, which is 670. So we want to have, basically want to take care of October with the 355, and then we want to also add in the 335, which is half of November's production, right? 670 is the amount of pounds we would buy for November. We want to add half of that to October. But think of that, part of that is like safety stock, if you will. So therefore we would need to get 690 pounds, right? The 355 that we need for October, and then the 335, which is half of November's required production. If we add those together, we get 690. Then we go look and say, well, how many do we already have? We've got 178 sitting there. Let's take those out. And then we need to purchase 512. So if we purchase 512, we'll have what we need left over, and we'll be able to satisfy the production for October. The materials cost per pound is 20, so we take the 512. We need to purchase 512 pounds times 20 is going to give us this 10,240. Same thing for November and December, but I'll just run through November real quick. Units to produce, 1,340 times 0.5 is 670. So we need to get, if we want to make 1,340 units, we need to purchase 670 pounds of material. And then we're going to add in our desired ending materials inventory in pounds, which is, in here it's 237.5. It's half of December, right? December we're going to need 475 pounds based on producing 950 units. So half of the 475 is the 237.5. So add this to your 670, we get the 907.5. And then we say, okay, well, what do we have in beginning inventory? Now, just like before, remember the ending inventory for one period is the beginning inventory for the following period. So that's why you're seeing these little arrows, right? The 335 on the last day of October is the same 335 that's now the beginning first day of November, okay? So we need to purchase 572.5 pounds of materials at a cost of $20 per pound. And if we do so, we would plan on or budget on spending 11,450. All right, the cost of direct labor. Direct labor is really simple. Those were probably the hardest too. So the cost of direct labor is the units to produce times the direct labor hours required per unit times the direct labor cost per hour. So let's take a look at an example of that. So the direct labor budget shows the budgeted costs for the direct labor that will be needed to satisfy the estimated production for the period. So here you can see, again, October, November, December, units to produce. If we're going to produce 710 units in October, the direct labor hours required per unit is 0.25, so basically 15 minutes to assemble a unit. So therefore we would need 177.5, right? 710 times 0.25, 177.5. And it's the exact same with November and December. The direct labor cost per hour is 12. You can see that's all the way across, 12, 12, 12. So therefore our cost of direct labor for October is 2,130, 177.5 times the 12 is the 2130. And the exact same logic applies to November and December. So what about the factory overhead budget? So this is going to show the budgeted costs for factory overhead that are needed to complete the estimated production for the period. So let's take a look at an example of that. So direct labor hours needed, we need 177.5. In fact, if you notice, the 177.5, 335, 237.5, if you go back, these are just taken from the previous direct labor budget, right? Direct labor hours needed, 177.5, 335, 237.5. So that's what you're seeing here. Variable overhead rate per direct labor hour is apparently $10. They just gave you that. You didn't have to calculate that. So then we just multiply these out. 177.5 times 10, 1775. The same with these two. And then our budgeted fixed overhead is $1,500. And notice that doesn't change, nor should it, because it's fixed. It's not relative to production. And then we just add our variable component and our fixed. So like for October, 1775 variable plus 1,500 fixed is the 3275 total. And it also just notes down here, the variable portion of factory overhead is assigned at the rate of $2.50 per unit of production. That's where we're getting these numbers from. The fixed overhead, as you can see, is $1,500 per month. All right, product cost per unit. So we can compute the product cost based on what we know from direct materials, direct labor, and factory overhead. So for budgeting purposes, this company assumes it will normally produce 3,000 units of product each quarter, yielding fixed overhead of $1.50 per unit, and all their other costs, the product costs, are all variable. Okay, so we have direct materials cost of $10 per unit. We have direct labor of $3 per unit. We have our variable overhead of $2.50 per unit. And then if you break it down on a per unit basis, remember this 1,500 fixed overhead from the last slide here. Then we have, based on 1,000 units of expected production per month, $1.50. We have a total product cost per unit, $17. And remember, the 17 is the total product cost, right? It is not what they would be selling that for. They would obviously apply their markup, their margin to that 17, but the 17 represents their total cost. All right, cost of goods sold budget. So the product cost per unit is then used to prepare the cost of goods sold budget and the budgeted income statement. Okay, so the way we do this, budgeted sales units times the product cost per unit is going to be our budgeted cost of goods sold. So think about where we got these numbers from. These are from the initial sales budget, 1,000 unit sales in October, 800 November, 1,400 December, and then they're just multiplying them by the 17, which of course is, as I went back one slide, is the total product cost per unit, 17. And then we've calculated our budgeted cost of goods sold for each period accordingly. All right, selling expenses budget. So budgeted sales, 60,000, 48, and 84, again from the sales budget. Sales commission of 10%, so they're just multiplying by 10%. So like for October, budgeted sales are 60,000 times the 10% is your 6,000. And then there's also sort of a fixed expenses salary for the sales manager of 2,000 all the way across. And then they're just adding their variable and fixed components to get their total selling expenses. So like variable 6,000 sales commissions for October, and then the 2,000 salary for the sales manager for October for a total of 8,000. All right, general and admin expense budget. So the company has general and admin salaries of 54,000 a year or 4,500 per month. So you can see here they're just adding up admin salaries 45, 45, 45. General and admin expenses the same 45, 45, 45. So they have totals of 13,500. So that's a very simple one. Capital expenditures budget, excuse me, or sometimes we just say the CapEx budget. So this just reports expected cash receipts and cash payments related to the sale and purchase of plant assets. So you can see in October, November, there was none of that. In December, they had a purchase of equipment for 25,000. All right, so the next step is to prepare what we call the cash budget, which shows budgeted cash receipts and cash payments during the period. So the general formula we use for the cash budget is as follows. We have the beginning cash balance plus money coming in, that's budgeted cash receipts, minus money going out, budgeted cash payments, equals our preliminary cash balance. If it's above whatever we want our minimum balance to be, we may repay loans. If it's not, we may increase loans to get it up to the minimum balance. And then we will yield an ending cash balance. So as an example, so if we have sales of, don't really worry about, they've included September because part of that will be collected in October, right? So if you look at sales in September, 42,000, it says cash receipts from cash sales, 40% of current sales, and then collections of prior period sales, 60%. Right, so all we're doing here is we're just basically plugging in percentages, if you will. Right, so like for example, October 60,000, so times 40%, right, is going to give you the 24,000, and then they're going to collect the remainder in November, right? And you can just kind of work your way down. You can apply the percentages in order to determine, okay, in October, we're going to get part of October. We'll also get part of September, for example. So, like for example, if you think about the 42,000 in September, 60% of that's going to be collected in October. So you can see 42,000 times 60% is going to give you your 25.2. And that's basically all we're doing for each period. So like November, 48,000. Cash sales, 40%. So 48,000 times 40%, 19.2. And then collections of prior period sales, the 60% would now be the 60,000. So all you got to do here is just think about the collection patterns. They're telling you 40% current period, 60% following period. And then once you've done that, just add them all up at the bottom. All right, so budgeted cash receipts with respect to timing. So you can see schedule of cash receipts from sales, right? So they've got the money that's coming in from sales, right? This is, if you go back, you notice this is this part right here, the top one, is exactly what we just looked at here. And then below the schedule of cash receipts from sales, you have the various amounts, like for example, cash receipts from, and then cash sales, 40% of current sales, 33.6. And they put a note down here to let you know, 33.6 times 40% is the 84. And then collections from one period ago, and then collections from 2 periods ago. So whenever you're doing these cash receipt budgets, it's just always a question of pay attention to the sales amount and then how is it being collected. Like, 40% current period, 60% following period. Or it could be like a third this month, third next month, and then a third 2 months out. All right, cash payments for direct materials. So here you can see, we have various materials going out. So current period purchases, they're not paying, like if you look at the 7,060 materials purchases for September, nothing going out in September, it's all being paid in the following month, right? So you can see 7,060 is being paid out in October, and then the 10,240 is being paid out in November, right? The 11,450 in November is being paid out in December. And then if we look at payments over several periods instead, so you can see here like materials purchases for September, all the numbers are the same, right? 7,060, 10,240, 11,450. Now we're just doing it slightly differently, and we're saying 20% current period purchases and then 80% the following, right? So we have if you look down here, like 1940 times 20% is the 9,700. And then 9160 is 80% of the 11,450. So once that's been done, then we can just basically put all this together. So you'd basically plug all this in from the prior periods, from the information that we just gathered. Think about these, our budgeted cash receipts, and then our budgeted cash payments, right? So all this has been added in. What I really want to draw your attention to is once we get down to here, right? So like preliminary cash balance for October, 25,635. Additional loan is 0, and then they've decided to repay 56.35. So their ending cash balance is they want to keep it at least 20. They basically said, well, we got 25,635. We've got 56.35 more than our minimum balance. So let's go ahead and use that to pay towards the loan. And then the same thing for November. If we come down to preliminary cash balance, 43,246. No need to take out any additional loans. And then they paid off the 43.65 that they still owed on the loan. And you can see in December, come on down, preliminary cash balance 44,706. No need for any additional money, nothing to repay. So the 44,706 stays the same. All right, so what about preparing the cash budget with respect to the loan activity? So the cash paid for the interest is the interest rate times the beginning loan balance. The interest rate is very low, 1%. So 10,000 times 1% is your 100. November, 43.65 times 1% is 44, rounded up obviously. And then the beginning loan balance, December was 0, so any number times 0 is 0, so there's no interest cost for December. And then once we've done that, all we have left to do is prepare a budgeted income statement. So all these, you can kind of go back and look. You can just go look at the sales budget, go look at the cost of goods sold budget, go look at the sales commissions, go look at the sales. All these numbers that you see here are coming from what we already calculated, with the exception of income tax expense. which I put a note in here, 98,756 times 40%. And then we'll get our net income of 59,254. For the budgeted balance sheet, kind of the same thing again. We're going to have our ending cash balance 44,706. In fact, if I just go back real quick, you can see ending cash balance for December 44,706. And then we would do the same for all of these accounts. All these, of course, are ending balances as of the last day of December. Okay, so that's it on budgeting, and I will talk to you all soon.